Hello, everyone. My name is Anurag, and here I'm going to go over some of the techniques of option trading. Option trading, like stock trading, has also some concepts and rules and policies. How the option trading is done and how to make money using option trading. Basically, I'm learning option trading in last several months, and I'm trying to share my learning through these videos. So I'll be having series of videos to go over some of the basic stuff, and then some of the strategy of option trading that I'm executing. And last couple of weeks I'm making some money. So this channel is not going to be like making a lot of money and making millionaire overnight, or sharing some magic wand so that lots of money will flow in. Just to sharing the learning so that you can use this as a input to your knowledge, and also go over, do your own research, find out how option trading is done and what is the best way to trade options and to make money in the market, right? So with that, let me get started with option trading, where buyer and seller transaction are done using a contract. So what is a contract? On one contract is equivalent to 100 stocks of underlying company. For example, one contract could be like 100 stocks of Apple or Google or Microsoft or Coca-Cola or Nike, something like that, right? So it always a transaction happens, buy or sale happens as a contract, not as individual stock. So that's a big difference from the stock trading, where you buy and sell. You can buy one stock or more, or even fractional stock. Here you can buy contract, 1, 2, 3, and as many as contract you want to buy. Each contract will have 100 underlying stocks, right? So the way option trading are done is either buy, call, or put, or sell, call, and put. So buy, call, and put are different way of making money, and going to predict your market trends, and also like betting on that trends. Like so, also the buy, call, and put, and sell, call, and put also can be in different combinations, and that could be a little more complex that I'll go over later. But right now, just simply call and put we will discuss. So buy, call, and sell put are two considered as a bullish strategy. What bullish strategy means is that you are bullish on the market. You think that market is going to go up. You think that company that you are trying to do option trading on is going to go up. So in that case, you will buy a call or sell a put. The bearish strategy is that you think that market is going to go down, or the company that of stock that you are trading is going to go down in near future. That in that case, you sell a call or buy a put, right? A couple of things to know about option trading is that, as I said, it's done by each contract, and you can buy one to many contracts, or you can sell one to many contracts, and each contract is 100 stocks. So when you buy a contract, you define a strike price. So you say, what, I want to buy one contract of Apple stock, which is 100 stocks of Apple, and you say, buying a call option with the strike price. So strike price means the price that you want to pay for Apple stock. So let's say Apple stock is right now market price is $90. You want to say, okay, I'll buy Apple stock at $100, and I'm going to pay a premium for that, because I know the Apple stock is going to go up, and I will make that, I'll get the difference when Apple stock is less than 120, 130, $150, and I will buy at $110, but I'm going to get the premium. I'm going to make the profit out of it, right? At the same time, when you are writing a contract, when buying a call or buying a put, you're also choosing expiry date when this contract expires, right? So from the day you start the contract to the immediate Friday, which is a week end of that week that you are writing the contract, as well as it could be multiple weeks, right? So it could be 2 weeks, 3 weeks, months, or year 7. So it could be a very long period, or at the minimum it will be the Friday, the week of the day that you are purchasing. So let's say if you are purchasing Monday, the earliest contract close date would be that Friday of that week. So one example of call trading is like, say, I'm bullish on Apple stock, and I think Apple stock will go a lot higher than 125. So I'm saying, instead of buying straight 100 stocks of Apple, which will take $12,500 right out of my account, I'll say that I'm willing to buy $125 strike price for Apple, 100 stocks of that, but I'm going to give a premium for that. So $5 is a premium. I'm willing to pay for 100 stock. That will be $500. So $500 will be only debited from your account, and you are not paying $12,500 for 100 stock Apple, but you will have a right to purchase 100 stocks of Apple at the price of 125 each stock. So if Apple price goes up like 127, 120, 130, 140, you will still be able to buy those 100 stocks of Apple at 112, 125. So you'll pay 12,500 at that time, right? So what happened in this case? Let's look at it, right? So you have paid already $500 or $5 each stock, a premium, and you are also getting a right of buying an Apple stock at $125. So $125, but the $5 you paid for premium. So actually, cost of your purchasing 100 stocks Apple, if you really purchase, is going to be 125 plus 5. So $130. So that is your break even. What does it break even means for this case is that until Apple stock goes above 130, you are not going to make any profit. You're going to make loss, right? So Apple stock has to be at least more than 130 to make break even, and then you start making profit. So price, let's say in a scenario where at the expiry or during expiry of the contract, Apple stock did go to 135. So in this case, you see your break even was 130. Now Apple stock is trading at 135. You can execute that contract. You get 100, purchase each stock of Apple in $125, but you can immediately sell that at $135. But you had a break even at 130 because you paid that $500 premium, which is $5 each stock. So your actual profit is $135, which your sell price minus your break even, which is 130, is $5. So $5 of 100 stocks, you will make total profit of $500, right? So that's how profit is calculated for call. Now, in the loss case, let's say Apple stock did not go as you expected above 130. So you bought the right at 125 to purchase the stock. You paid $500 premium for that. Your break even is 130, but the Apple stock went actually down and become like 115. Right now, 115. So you will not buy this stock via your contract of $125 where market price is 115. Because it is a loss, right, to pay more price. So if the contract will go waste, and what will happen is that you lose $500. So basically, you are not going to purchase at this price. So you're not really making $1,500 loss. Your actual loss will be actually happen is $500. So your $500 instead of profit, you'll make a loss depending on that. Now, as Apple stock goes down, you will continue to make this $500 profit, because $500 loss in this case, because it doesn't matter how low Apple stock goes, you're not purchasing this stock, and you are not paying 125 when you can from the market buy less than 125. So the premium that it paid is gone worthless. The contract will close at worthless, and you get you lost $500, right? In opposite direction here, you can buy at 125, you sell 135, your break even was 130. So you made $5 profit, you make $500 profit, right? Now, as Apple stock can go up 135 to 140, it can go to infinity to theoretically, right? And then you can make that much of profit. If your Apple stock goes 140, you'll make $10 profit between your break even and the market price, and you'll make $1,000 profit, right? So your profit potential is huge in this case. But as I said, the $500 loss potential and the lot of potential for your profit. So that's the buying a call. Similarly, buying a put is a opposite direction of trade, is a bearish trade. You are now in this case, you are thinking Apple stock will go down, and I'm taking Apple as example. It could be any stock, right? So you say, what, I'm going to sell and buy a put at 125, which means that you are now getting into a contract where it's giving you right to sell instead of buying. In the other case, it's sell Apple stock at 125. Now, why you are buying this, right? Because you think that Apple price was going to go down much below 125, and you're going to make profit because you will still be able to sell during that period of contract is still valid before expiry at 125. So you'll make money between the lower market price versus what you have the right to sell at 125, right? So for that, you also have to give a premium. Let's say you give premium $5, which is $500 total debited from your account for 100 stocks. Your break even now in this case will be 125 minus 5. So as long as Apple stock is above 120, you are not making any profit. So if it is go below 120, then only you will make profit. So let's say Apple stock is now 115, but you have the right of selling at 125. The difference is $10. So total profit is supposed to be $1,000, but you paid $500 premium. That will be debited from the overall calculation. So 1,000 minus 500 will be $500 profit in your case. Now, if in this case, Apple stock really go up right? If Apple stocks start going up and reverse directions and goes above 125, in this case, you will lose money. So let's say Apple stock does go to 135 and you had a break even at 120. So basically you are losing $15 and the $15 will be a loss because the ideally what will happen is that you will not execute on the buying put. You're not going to sell at 135 where you can sell in the market at 135. So your loss will be the premium. So you lose $500 instead of actually selling that at 125 and taking a bigger loss, right? So you will get this contract worthless, expire this worthless, and you'll lose $500, right? So you see that from the example of call and example of put, where you are buying call or buying put, you have to be directionally right? So you have to be, when you are buying call, you are bullish. So if you are thinking stock will go up, if it goes down, you will make loss. If it goes up, you will continue to make profit. When buying put, you are bearish. You think the market is going to go down, but if it doesn't happen, you will make lose. So understanding the market trend is very important. So here's a couple of tips for at least that much knowledge, and a lot more knowledge you need to have, but at least you need to be accurate on understanding market trend. And we will go over later on the videos how to see market trend and the stock trend, like is it bear market or the bull market, or is it the company stock is going up, and all that by looking at their moving average and by looking at their overall trend for a year and weekly chart and daily chart. We'll go over all those things, but at this point, I want you to know that you have to understand the market trend. You have to understand the stock trend. You have to be correct about those things. You have to determine the right strike price for that. So basically, you see that strike price is used in the calculations of how much profit you're going to make by defining the break-even point. So if you choose, let's say, buying call, you choose very low strike price, below or close to the market price right now, you will get very less premium, right? So you will not make a lot of income. Or basically in this case, buying call, you are giving premium. So your premium will be higher because you are buying in almost at the money or in the money. And in this case, you'll pay a lot more premium. And if you do lot less than the current price, so you are actually taking a lot of for profit potentials already for buying a call, you will pay higher premium. So you will do a lot of in the money, and you will see that you will make a lot more. You have to pay a lot more premium, right? In case of buying put, it's the same thing. The higher the price that you are buying the put, the higher the premium that you have to pay, because somebody is taking risk of buying the stock with very high price from you, right? So you have to be accurate. You have to be choose your right strike price, and we'll go over some of the best practice how to choose a strike price and optimum expiry date. So expiry date is basically 3 weeks to 4 weeks is kind of statistically average people determines. But also at the same time, once happens that, let's say your direction is incorrect and you want to, we'll go over on this rolling out and rolling up and out and rolling down and in options and all that. And so in case of rolling out, you are actually increasing your expiry date, choosing a further out expiry date. And, if you already chose 1 month, if you choose another 1 month, so it's going to be 60 days for that contract to expire. So you are taking a lot of time for execute on the trade. And also what's happening is that your money is getting stuck, right? Your premium that you paid is staying stuck on that trade. So that would be these are all not like exact science. So there's a lot of analysis need to happen, and you have to see what kind of risk you want to take, how much time you have to wait. Because in case of buying call and buying put, the theta, which is a kind of like a Greek that determines the time available for the stock, and that exponentially went against buying put and buying call executioner. So in that case, theta will be against you, and choosing the right expiry date for buying put is very, very critical. Couple of other things that I want to go over is the intrinsic value of the option trade. So if you choose a strike price, your intrinsic value is current price minus strike price. So in case of buying call, intrinsic value is good, because the more the intrinsic value, the more your strike price is below the current price, and you have a lot more potential to make profit. But as I said, the more intrinsic value you have, less extrinsic value you'll have, and premium will be higher. So that is the kind of like a thing about this option trading, is that you really cannot win on both directions. So you have to be really optimum to choose your premium versus your in the money strike price, so that you make highest potential of making income or making profit when you execute on the contract or you get assigned or something like that, right? Other couple of things that you have to know, what is called at the money. At the money means your strike price and current stock price of the market price of the stock is very similar, very same. In this case, the intrinsic value is equal to current price minus strike price will be close to 0. And in the money is that your stock price is above your strike price, which is a bullish strategy. So basically your call, when you are buying a call, if the strike price is already above the stock price, you are already in the money, and you can always sell in the higher price as stock moves. So basically your stock will be called in the money. Out of the money is stock price below strike price. In case of BRE, this is a BRE strategy where your stock price, below the strike price means your strike price, stock has room to go up to the strike price that you have chosen. So you still have a lot of way to make money. So in the case of buy call and buy put, out of the money is not good, in the money is good strategy. So you have to see, the more deeper in the money you are choosing a strike price based on the expiry date, you are compromising on the premium, but your profit potential will increase. So your probability of making profit versus your premium is kind of like inversely proportional. The more premium you make, the less chance of making the profit, and going the contract, not worthless, expired or worthless, or the lesser in the money, you take more close to the out of the money or at the money, you have little more premium to make. So it depends on whether you want to get executed, get assigned, and make profit, and buy deeper in the money makes sense. Then you get less premium, or you say, what, I'm going to just earn money and in generating income. So in this case, out of the money or close to ATM is the good idea, right? Secondly, there are option Greeks that I'm going to talk about, which are kind of like indicator for what kind of strike price and expiry date you should choose. So when you are ready to execute an option, you need to understand the market trend and the stock trend, but at the same time you need to choose the right delta. So what delta is measures underlying volatility of the stock price. So basically it is taking on consideration how stock is changing based on how premium is changing. So if $1 change in the stock price, underlying stock price, how much premium is changing. So that is determined or measured by delta. So delta is very good indicator of the volatility of underlying stocks and how your premium is going to swing based on the swing in the price of the underlying stock. So if $1 goes up or goes down, delta determines how your premium is going to change. If delta is 0.30, your premium will change 30 cents based on $1 movement of the underlying stock. And delta is positive for bullish strategy. So all the case of like a call and buying put, these are all bullish and bearish strategy. For bullish strategy, you will see delta are positive, and for bearish strategy, like selling a call or buying a put, in those cases delta will be negative, right? So you have to make sure that you pay attention to those when you are choosing an option trade and making that trade. At the money case, when strike price and market price are pretty similar, in that case delta will be near 0.5. So delta values range from -1 to +1, and in this case delta will be plus 0.5 if the trade is at the money. If trade is in the money, then delta will increase close to 1, and deeper as in the money, the delta value, positive values continue to increase, right? It's good for call, because in call you want deeper in the money, because you have then more chance of making more profit, because your strike price is getting farther away from the market price, right? Strike price is getting much more lower than the market price. So stock is continue to going up, you're getting deeper in the money, your delta value is increasing, right? So if you buy a strike price of Apple 120 and Apple goes from 130 to 140, you will see that delta value is increased to the positive directions and going towards a value of 1. It could be 0.8, 0.9. So selling put and out of the money is another thing that out of the money delta value is decreased. So good for selling call and buying put. So the lower the delta, better make chance of actually making profit is more. So when you selling a call or or buying a put, in this case you will choose delta value that are lower. So lower means traditionally the lower the delta will go, also your premium will be less. So you have to see that what is the best option of going out of the money for selling call or buying put, and the balance between the being out of the money as well as the premium that you're making. So you have to make some premium if you're selling a call. So you cannot take a lot of deep out of the money. In that case, premium will be low. And also, if you choose lot higher premium and very close at the money, or very little out of the money, in this case, what will happen is that you make a lot of premium, but your chance that it getting executed will be high. So you're selling call, your stock will be sold, and buying put, your stock will be also sold the price that you are trying to pay. Tips for buying call: higher positive delta is good. Buying put, higher negative delta is good. So the lower the value means the higher negative value is good. Selling call, lower negative value is good. So similarly, for selling put, lower positive value is good. The lower value of the more it goes to less than 0.5, selling put is good. For selling put, that value is good. So let's take an example here. I'm showing a Shopify. Shopify is the stock price right now is $31.73. And you bought a call at $19.50. So you see that you had a call $19.50, which is below the market price. So you are already in the money, and it's actually deeper in the money. And you will see the delta value is very high, close to 1. So probably delta value in this case, I can show that it's 0.96, which is close to 1. And premium is $12.43. So premium, that is what you paid to buy this. So you see, the more chance you have, the higher delta, the premium that you are paying is also huge. So intrinsic value is the current market price, 31.73 minus 19.50, which is your strike price. So that would be 12.23, and extrinsic value is premium minus intrinsic value, which is 20 cents. So you have a very little extrinsic value left on this stock, so which is good. Now you see, if you can execute this right now, you can buy the stock at $19.50. You sell that at the market price of 31.73, and you make a lot of profit, $12.23 per stock. So in 100 stock, will make $1,223, right? So that's a good money to make. Let's say the current price becomes like $32 of the Shopify stock. So basically now you are at the money, because let's say you choose $30 the strike price, and your market price is $32. So basically your delta will be very close to 0.5. As I said, at the money, delta will be 0.5. So you see 0.54. Premium is less, 2.91 is not that bad. So that much premium you have to pay. So for 100 stock, you have to pay $291. Intrinsic value, there's no intrinsic value, because delta is 0.5 and you have market price minus strike price. They are very close to each other, so difference is 0. Extrinsic value is pretty much the premium. So the stock has room to go up and make you money, and you're not going to make a lot of money right now, because the current price and your strike price is pretty same. So basically you have a lot of room to make money. If stock price goes up from $32 to $37 or $39, then only you start making money, and your extrinsic value will be lesser and lesser. And delta, another case of out of the money is like stock is now $17. So here in this case, your call will go worthless. You see delta is very low, which is not good for buying a call. Your premium is huge, $14.50, because you already choosing a very low stock price is a lot of room to grow before you can make any money from the stock. And your intrinsic value is negative, and extrinsic value is huge. So that is how call is very good if to choose a delta that is close to 1, at least between, like I would say, that 0.9 to 0.95, and choose the right premium based on that, and you'll do better. You have a better chance to make money. So let's go to Robinhood and show some of the examples there and understand how buy call and sell call works. So here I go, search with this ticker Apple, and then I select trade Apple options. And here I see I have a buy and sell. I can do buy call, buy put, sell put. I can choose a different expiry date here. So let's do next Friday, which is June 16. And see here is that, let's say I want to buy Apple call at, let's say, close to like, at the money, right? So 180, you'll see that this has premium of 2.65. So basically I have to pay $2.65 per stock. So immediately I have to pay $265 from my account. but I'll have a right to buy Apple stock at $180, which is already in the money because the stock price is already up. So if I execute that, I immediately make $81 profit, but at the same time paying $265, which will be lost trade. But you look at the Greek here, right? Greek is not close to 9, right? Greek close to 1. Greek is 0.6. So basically it is close to 0.5. So that is kind of at the money delta, which is 0.6, not good for call, right? But then if you buy call at, let's say, at let's say, you think that the market is bullish, Apple stock will go up. So let's say you buy call at 185. You see that the delta is pretty low. So basically it's now getting out of the money much higher than the market price. So you are seeing delta is higher and it is getting out of the money, and your premium will be 0.567. So you have to pay only $57. But you are taking a risk because if Apple doesn't move much and say below 185, you will lose money. You lose at least the premium that you are paying for that, right? And if you choose much lower value, which is deep in the money, you say select, and you will see that delta value is increasing. Now it's going close to 1, and you see your premium is also going up. So you pay the price for getting higher delta, so that you already have a profit on this account, right? So you're buying you're purchasing at $180, but the current price is $177, right? If you keep going lower, you will see that delta is increasing, right? So that is good. The lower the strike price is choose, good for buying a call. Your premium will continue to go up, so you have to pay a lot more money to get the profit. That is this stock. This trade is already in profit because you already can. You're buying at 175. The market price is 180, so you're making $500 profit. For that, you're paying $660. So that is not a good trade. But you see that how things works for delta versus the strike price and all that, right? So you have to choose the right strike price, right? In this case, like if I really have to buy call, probably I'll buy at 182.5. You see, it will be like 0.4, 0.39 delta. And here I'm paying only $136, but I have a potential profit. So my break even would be 182. My break even would be 182.5 plus $1.36. So 183. So if stocks goes around $183 and more, $183.8. So basically $184 and more, then I start making profit. So my break even is not that bad. So much, right? So, or I can do one thing, I can change my expiry date. And you see now the whole things has changed, right? So let's say I choose June 23, and you see that for the same strike price, 182.5, the delta is 0.43, which is close to the stock price. And if I choose, like, as market is already bullish, you see that if you choose the higher stock price, your delta is going to go down. And if you choose lower price, your delta will be very very high, close to 1, so 0.88, right? So that means you are deep in the money, buying a right to sell, buying right to buy the Apple stock at $172. So that's how it works. In case of put, it's kind of like opposite, right? So you see that if you have June 16th and you say, you know what, I want to sell Apple stock right now, it's trading 180, but I will sell at 180, the current market price. You are paying a premium for that at $1.41, which is not bad, because you anyway could have sold that in the market around $1.81 more than this. So you definitely do not choose that. You will choose higher price than the market, and you will see that your premium is going up. So the money that you are trying to make by selling at the higher price, you are paying also premium. So the difference of the premium and the price is strike price is to be calculated to calculate break even. So in this case, break even will be 182.5 plus 2.67 minus 2.67. So Apple stock has to be less than, in this case, 182.5 minus 2.67. So 180, kind of like, a little bit less than $180, I think $179.8. So let's say $179.8. So if Apple goes below 170, $9.8, like somewhere here and then below, then only you'll start making profit. So your break even will be your strike price minus the premium. So strike price is 182.5 minus 2.67, and stock has to go lower than that for you to make any profit. So in this case, you will see that delta value, the lower that you are choosing, the delta is becoming more and more negative. So you choose 175. and you see that your delta value is going lower and lower in the negative, right? Lower and lower in the negative, right? So it's going to close to negative zero. So, okay. So that's all for now. So basically what we went through is that we went through how to buy call, how to buy sell, what is the way of making profit, what is how to calculate your profit and loss in case of price goes up and down for buy call and buy put. Call is a bullish strategy, put is a bearish strategy. In case of put, you want price to continue to go down till your expiry. In call, you want the stock price to continue to go up till your expiry. If you would like to buy the stock, you can buy at the lower price. That's the whole purpose of buying call. Or if you don't want to buy the call, you want to expire, and you just paid the premium, so it should be a loss. In case of buying put, if the stock price remain above, then your break even, then you lose your premium. But if it continues to go up below your strike price, then you'll make a profit. And delta is one of the most significant Greek, or I would say that indicator for choosing a right strike price and for what kind of transaction you're doing, is a buying call or buying put. So you have to be very careful that for buying call, higher positive delta is good. For buying put, higher negative delta is good. For selling call, negative delta and lower value of delta is good. For selling put, lower positive delta is good. So make sure you understand those things before you make trades. And we'll go over exact different other concepts of other Greeks that make sense for theta, which is like time decay, that we'll go over in the next call. But overall, these are the things, are the basic 101 for option trading, and we'll go over but we will build upon on this concept. So anything that we learn next will be depending on this. So make sure you understand call, put, and delta pretty closely. Find out how premium value changes based on the delta, how ATM, OTM, and ITM works, and how to calculate premium, intrinsic and extrinsic value on the trade, right? And how that changes as time pass by. So thank you very much, everyone. Again, this is a place where I share what I'm learning about option trading. I'm already doing some option trading for past month, and I'm kind of like trying my hands on a very little money. So this is not a financial advice or anything like that. This is just sharing my educations for other folks to kind of learn. Also, there are also definitely, you have to not to jump on making any trade as this moment, because if you are learning for fresh or brand new or this concept, so it's better to just capture a lot of knowledge before you try anything. And once you feel a little more comfortable, try with very little money, right? So I'm not touching one of my biggest investments like Tesla, Apple, or Microsoft even, right? I'm touching very little money, and it's all about your own learning and your research that will make you expert. Not listening to any YouTube video like this, but I'm just sharing my the way I'm approaching this, so it might be helpful for some folks. Thank you very much. Have a nice rest of the week.